What's up, everybody? Eric here. Time for a reboot on my favorite strategy, the Covered Strangle. My goal is to do a in-depth but quick video. So I'm going to try to run through all of it within 10 minutes. My other more in-depth videos will still exist. They're just a little older. I want to go over some new details. So if you want the more in-depth version, check that out. I'll throw a link up here and then also in the video description below. But otherwise, let's get straight to this trade. So this is hands down my favorite strategy. I deploy this almost, tough to say. I would argue at least 70% of my trades. I do ebb and flow based on market conditions, obviously, but this is just such a utilitarian trade that is so good in so many different circumstances. And my favorite part about the trade is the way that I define an edge in the trade is via management. That's not me being any sort of great stock picker, being able to guess direction. It is the ability to structure well-developed trades that take advantage of different option pricing and just option conditions to try and increase the overall success of the strategy. And I would say between this and diagonals of some sort, these are hands down the vast majority of my trades. So what is the covered strangle, or the cash secured strangle, as my mentor likes to refer to it as? Essentially, we're going to start with a cash secured put, then we're going to roll to a covered call, and then we add another cash secured put on top of that. So let's take a quick look at what this flow chart looks like so it's easy to conceptualize, and then we're going to go through the rest of the details, how we're going to set the trade up, where we're going to look, what kind of things we want to see, how we're going to management, and then some notes at the end. So like I said, we're going to start with a cash secured put. So this means that we're going to sell a put and we are expecting to be assigned if things go poorly. That doesn't mean that we're going to be assigned. It doesn't mean that we're not going to defend and roll a position, but it means that we are prepared to be assigned. A couple really important implicit components to that. The main one being is you don't mind the underlying that you're going to be trading. And a lot of people that trade puts, they always say, oh, I don't mind ownership. But then as soon as the stock drops 15%, their put is, 10% down. They're like, well, I don't want it here. That's not how that works. So it's really important to truly like what you are holding, because if you're going to get assigned on a cash secured put, it means that the underlying is going to be trading below your strike. A lot of people like to say, oh, well, if I just sell a put, I'll buy the stock at a discount. Yeah, you're going to get it at a discount to the current price. But if you're getting assigned, it means that you're at a premium to the then price, because your put has to be in the money. So it's just important to keep that in mind. So if we sell that put, the easiest scenario here is that it's going to be out of the money, or we're going to manage it at a profit. And then that leads us back to the cash secure put, and you just kind of recycle those. The other scenario is you're in the money. Now, my first approach when we're in the money is to look to roll the trade, which we will get into detail in a minute. But essentially, rolling is just a way for us to close out that existing trade. We are going to book a loss. However, we are going to establish a new trade that has a profile that allows us to take in an overall credit so that we can make money on the entire trade without being assigned. That being said, we can also be assigned. So if you take a look at the assigned tree over here, there's two segments. We have the covered call side and then an additional cash secured put. So this cash secured put that you see here simply follows this tree that we already went over, essentially everything up there. Now, while the cash secured put side is relatively straightforward, the covered call side isn't anything too crazy. We're just combining two different strategies at the same time. So for the covered call, you're going to sell short calls against the long stock that you're assigned. On those covered calls, there's two potential outcomes. The first one is those covered calls, the short calls, are out of the money, meaning your calls are either managed at a profit or expire worthless. And then you just do it again, sell another covered call, as long as you have the ability to collect some money, which I'll also explain in a little bit. For the in the money side, if they fall in the money, that's perfect. That's best case scenario here. We don't want to do anything. We want to let them expire in the money. The long stock that you now have will be called away. And then essentially you just circle your butt right back up to the start here and do it all again. So the true power in this strategy comes in multiple forms. It's definitely management, and part of the management approach here that's really important to understand is sometimes you have to wait. Nobody likes to do that in trading. It doesn't feel very sexy or fun, but that is important. And the reason why waiting is important is because let's say that we're assigned and we have long 100 shares of XYZ and our basis is 10, and right now it's trading at 6. We're not going to be able to sell covered calls above our 10 basis if the underlying is trading at 6 at a 40% discount to where we're at right now. If you try to sell short calls there, more likely than not, you're going to get 2 cents, 3 cents for a 50-day trade. It's not enough money, in my opinion, to cap your potential upside. In those circumstances, my preference is to wait. You said at the onset of the trade that you're comfortable holding the underlying. Do it, because if we start trying to sell calls too early, let's say we do get a rally. Now those calls might be trading at $2. You got 2 cents for them just because you want to try to collect something right at your basis. And that leads to the next problem. You want to be able to sell your covered calls above your basis. So if we are assigned at, same example, at 10 and the underlying is trading at 6, you don't want to trade short calls ideally at 10. You want to be able to have some capital gains on the short calls. So you're going to want to be selling them at 12 or 13. You need to give the trade a little room to the upside. All right, let's move on to the setup. These are the things that I look for in general. This isn't an all-inclusive list, but this is a general guideline to help give you some ideas. The punchline here is you are wanting to trade things that are liquid and that you don't mind holding for real, for real. Again, not just saying it, but you really mean it. So these are products that you might be holding for a year, 2 years, 3 years. Find products that fit that profile for you. So I tend to use sector ETFs or index ETFs. Those are my favorite. As anybody knows that follows the channel, IWM is typically my go-to. And you can also, I also venture into individual S&P 500 stocks, and that's just because there's some inherent screening going on there. If it's within the S&P 500, it tends to be a pretty strong company. So you can find reasonable things in there instead of kind of just chasing premiums and selling some random ass stock that is paying a bunch of money. P.S. They pay a bunch of money for a reason. It's because it's super volatile. And it helps eliminate some of just unnecessary risk, in my opinion. So I do like to look for things that have weeklies. A lot of times that will indicate a certain level of liquidity because the OCC and just the exchanges in general don't immediately offer weeklies. There has to be enough demand volume there. That's not to say that weeklies can't be illiquid. That does happen. You have to check it. But in general, it's a good place to start. Now, this is a short premium strategy, so I tend to prefer higher implied volatility percentile. Something higher than 25% typically is good. The main reason for this is you don't want to get stuck in a bad position where you sell some premium and then IV expands even further and then you lose potential profits or you're seeing an unrealized loss unnecessarily. So keep an eye on that. You definitely don't want to sell these in really, really low implied volatility percentile environments. It just sets you up for failure in kind of two ways, right? You have directional risk, and then you also have volatility expansion risk in this trade. So we want to limit that. Price and trend, super important. Also, side note, it's already 8 minutes, 50 seconds in. There's 0% chance I'm going to finish this in 10 minutes, so I'm sorry. But for price and trend, there's kind of two ways I think about it. Sometimes I will go with the catching a falling knife, where I'm looking for some sort of trend reversal. I want to see something that is kind of making big declines, maybe on a 3-month chart is declining, but on a 6-month, 1 month, it's uptrending. A couple really important, just general technical analysis tools that I look at. Again, these help inform decisions. They're not hard rules, but I prefer it to be generally uptrending. So that means short-term moving average above midterm, above long-term. I also definitely prefer price above the long-term and midterm. If it's below the short-term, I'm a little more flexible on that. I also want to make sure that it's trending up at least on a yearly chart, preferably on a 6-month and yearly. I also like to look at some fundamentals. So to make sure that we have growing free cash flow, if it's an individual stock, I want to make sure that there are growing sales. Those are really important for longer term trades. Shorter term trades within a year, the multiple tends to drive a lot of the price performance. So it's another thing I like to look at. Multiple something around or below industry averages. So for the short put itself, when I'm sending that out the door, I like something that has at least a 1% return on an invested capital. So you can take a look at whatever total premium you're going to need to cash secure that position, figure out the credit you're going to receive, divide the credit by whatever it is to cash secure that position, and that's how you get your return on invested capital. Dividend optional. I like to look for something with a dividend if it has one, and it's still something that I like. I'm not going to go chasing them, but it is something I'm aware of. If I have two products that are essentially equal in most dimensions and one pays a dividend, one doesn't, I'm going to go for the one with the dividend. Kind of straightforward there. Then we get into a little bit of management here. So let's throw the rest of this up. I want to talk about these two and how this fits in with the rest of our management plan. So for management, max profit is going to be whatever the credits you receive over the life of the trade plus the capital gain on the stock. Max loss technically is unlimited. However, a stock can only go to zero. So that is your max loss if it goes to zero. Now, when we're looking at entering this trade, we find what we like. We need to figure out our trade allocation and then our initial outlay. This is an important concept. So when we're trading like an index ETF, I don't mind allocating a lot of the portfolio to that, because if for a while, I would trade levered in something like IWM. And then if I was assigned on 100%, had to close some for a loss, but then I was just going to sit on 100% of my portfolio in IWM, no problem with that whatsoever. It's an index ETF. I'll hold it for 10 years if I have to. Doesn't typically happen, but what I'm saying is make sure that your allocation is a size that you're comfortable with based on what you're trading. If you're trading individual stocks, I like to use no more than 8% of the account in an individual stock. Sometimes it might flow to 10%, but that's about it. Not so much anymore. Normally it's way smaller than that, probably, 2 to 5%, just because I don't really venture into individual stocks a whole lot at this point. There's not a huge drive for it, but I do on occasion, and that's where I look for. And then your outlay is how much of that allocation are you going to use when you're setting the trade up, and then your scaling is how are you going to add additional capital to the trade. So let's say that you set $50,000 aside for a trade. And let's say on your outlay, you use $20,000. Means that you have $30,000 left. When are you going to use that $30,000? That's what scaling is. So let's talk about how those two look based on this right here, entry off of delta. So normally I'm going to enter my cash secured put with 3 or 0.3 or 0.4 delta, typically somewhere between the two. And what I find is that gives me a good balance between the premium I'm receiving as well as not necessarily fighting every single trade that I have on. The higher your delta, the higher the probability is that you're going to be managing that trade at some point, but the higher delta, the more you're going to get paid for it. The other thing to make sure that you're doing when you're checking out these credits that you're going to be getting is check the theoretical price. It is another way to confirm if you are paying too much or too little for an option. Really easy to do that. You can use a Black-Scholes calculator in Excel. You can add it to your platform. That's what I have on as well, just because it's quick and convenient. But it is important to take a look at that in conjunction with your implied volatility percentile level, because your theoretical pricing gives you an idea if you're slightly overpaying, slightly underpaying, or if you're grossly overpaying, grossly underpaying. So you want to avoid those ladders. All right, let's talk about percentage off of highs and then how that ties to your outlay. So we talked about that $50,000 allocation. Instead of just saying, well, I'm going to use 20,000, I like to use some guidelines to inform my decision making. So in this instance, let's say that I'm trading IWM and we're greater than 40% off of all-time highs. I'll use 90%, even 100% of that allocation on the initial outlay. If we are less than that, I tend to use smaller outlays. The reason for this is, again, just an assessment of risk. If we're 10% off of all-time highs or recent highs, there's probably a pretty good chance, at least at some point within the next year or two, that there's going to be a pullback. I don't want to be fully invested during that pullback because scaling is an important part of managing these trades. So what scaling allows us to do is to remain sensitive to the basis of the underlying. So if we're trading something like IWM and it starts to drop, by scaling in via additional cash secured puts that are below our basis, one, we have an opportunity to continue to realize profit. I have a video that compares the wheel to this strategy, and it explains this exact point. I'll link to that up here for you all as well. But essentially, by remaining and having capital ready to use during a down move, it's an extremely advantageous position to be in. All right, so let's slide over to just general management. Typically, I'm going to manage these at 60% credit received, or if we're within a week and I see something between 30 and 50% max profit, I might take that trade down. It really depends on the broader market circumstances, how many trades I have out, how much risk I'm trying to take in or expose myself to, but just some general ideas to use. The other thing is, once we start getting around 20 days to expiration, normally I will offer these out at, 50, something between 30 and 50. And if we start getting within 20, so 18 days, it's important to note that our gamma risk over here starts to raise significantly. Gamma risk is just the rate of change of delta. As we get closer to expirations, options that are out of the money want to move to a 0 delta. Options that are in the money want to move to a 1 delta, because that's where they're going to approximate at expiration. So it's important to know that once we get within 20 days, gamma, or your delta, is going to move very quickly. So that's why that window is something, at least for me, to look at. Again, none of this is hard written in stone, never deviate, but it is important to know. Now let's talk about this section here when we're rolling or assigned. If we're gonna roll, that's typically my first preference, simply because if we're rolling, it means that we're being challenged. It's hard to know when we're at the bottom of a bear market or something. So I do my best not to get caught at the top. Rolling sometimes just doesn't work, and you might run out of capital to add to the trade. You might run out of reasonable rolls, and you might just take assignment at that point. I've done that plenty of times, but my typical preference is to roll. Now, your best time to roll is when the stock equals your strike price. Not saying that's when you should roll, it's just when you're gonna have the most opportunities. And what I mean by that is when your stock equals strike, if you want to roll, you'll almost assuredly be able to go out a couple weeks and move your strike out of the money or further away from the money, more often than not. The issue is, once you end up further and further in the money, you have less and less extrinsic value. That means that going further out in time by 2-3 weeks isn't going to help you that much to get a credit, or to, more importantly, aggressively adjust your strike. So I use stock equal strikes as the first time for me to look for a roll. Typically, I will wait, and typically it'll go further in the money, and I will use risk as a way to manage those trades. So once we start deciding, okay, I'm in IWM, I had $20,000 initial outlay, I want to add an additional 8 to 10% of my allocation, at each 8 to 10% drop in IWM, I want to add more of my risk. The amount of that risk will definitely depend on the rest of your portfolio plan, your outlook of the underlying, things like that. But typically for me, I like to maybe add 10%, something like that. So what I'll do is say, okay, we move down another 10%. I want to add another 10% of my capital to the trade. That allows me to do exactly what we were talking about before, which is slowly scale into the trade. Now, when we are in the money, it is important to monitor how much extrinsic value is left in those options for early assignment. If you see less than a dime in extrinsic value in the options, you're definitely at risk of early assignment. Make sure you take a look. It's not a huge deal. If you get assigned early, you can always unassign yourself provided you have the capital. And you know your broker's not going to lose their shit, but otherwise it's really no impact. It's just something to work around. Now, when we do have the covered call out, I like to have a ratio, meaning if I'm long 500 shares of the underlying, I like to sell 2, maybe 3 covered calls against it. And the reason for that is so that I allow unlimited upside potential. I like that scenario. The other thing, like I mentioned before, do your best to allow for capital gains, meaning don't sell your short call right at the same price as your long call or as your long stock. Sorry. I think that's a bad idea. And you really kneecap a lot of the potential return of the strategy, especially there's an opportunity cost to hold. So if you sell a short call against your long stock, you collect that premium, whatever that is, that's it. That's all you got on that side of the trade. There's an opportunity cost that you just gave up there. We talked about gamma risk. We talked about not chasing premiums and essentially getting into bad products that you don't really like. The last one is make sure you check your weekly liquidity. I mentioned that, but liquidity is going to be king, especially because when we're rolling, I prefer not to roll out super far out in time. I like to roll out as little in time as possible while collecting a credit, while ideally being able to adjust my strike at the same time. All right. That is the Covered Strangle speed round. I literally doubled the time that I thought I was going to try to hit, but I didn't want to skimp on the information, so I'm okay with it. As always, if there's any questions or anything, let me know. Like I said, I do have the more in-depth videos that you could check out. There's a bit of a series there, but until next time, I'll catch y'all later.